This market does not look dangerous. That's the problem. Stocks are near record highs while the US is carrying nearly $38 trillion in debt, refinancing over $7 trillion in the next 2 years at interest rates 3 times higher than before. Households are spending again, not because they're strong, but because savings are gone and credit is filling the gap. The Federal Reserve is trapped. Interest costs are racing toward $1.5 trillion a year and growth is slowing beneath the surface. Crashes don't start with panic. They start when confidence is highest. And the clock is already counting down. The danger is not the size of the debt alone. The danger is when that debt must be paid again. The United States is approaching $38 to $39 trillion in total federal debt. But the real fault line sits in the refinancing schedule. Between 2026 and 2027, more than $7 to $9 trillion of Treasury securities mature and must be rolled over. This debt was issued when interest rates hovered near 0 to 1%. It will be refinanced into a world where rates are 4% to 5% or higher. That single shift quietly multiplies the cost of survival. This is not abstract math. Every percentage point increase adds hundreds of billions in long-term obligations. Federal interest expense, once under $400 billion, is already racing toward $1.3 trillion per year. If rates remain elevated, that number moves closer to $1.6 trillion, rivaling defense spending, Medicare, or Social Security. Interest becomes one of the largest line items in the federal budget without producing a single road, job, or service. This is where the system tightens. Rolling debt at higher rates forces 3 outcomes, and none are optional. Either taxes rise, spending is cut, or borrowing accelerates even faster to cover interest on past borrowing. Each option drains economic oxygen. Higher taxes suppress growth. Spending cuts hit employment and services. More borrowing spooks bond markets and raises rates again. The cycle feeds itself. What makes this window uniquely dangerous is timing. Treasury issuance does not slow just because markets feel fragile. Refinancing happens on schedule, regardless of sentiment. At the same time, foreign demand for U.S. debt is weakening. Major holders are no longer absorbing issuance at past levels, forcing heavier reliance on domestic buyers, banks, and the Federal Reserve. That shifts stress inward, concentrating risk inside the financial system. The illusion of stability survives only as long as confidence holds. Bond markets tolerate rising supply until they don't. Yields rise quietly, then suddenly. Auctions fail at the margin before they fail loudly. Liquidity disappears first in corners no one watches, then across everything at once. This is why the rollover matters more than headlines. It turns past policy into present pressure. It converts old promises into new cash demands. And it does so on a fixed calendar that cannot be delayed by optimism or narratives. This is not the moment the system collapses. This is the moment it loses flexibility. And that loss forces every other weakness into the open. The debt rollover demands one thing above all else: sustained income growth. That growth must come from the labor market. And this is where the structure begins to fail, not loudly but invisibly, while markets remain distracted. Headline employment looks intact, yet hiring has slowed to a crawl. Major employers are no longer expanding workforces, they are preserving margins. Amazon, once a reliable job engine, has flattened corporate headcount after cutting tens of thousands of roles. Google, Meta, Microsoft, Salesforce, and IBM have shifted from growth hiring to efficiency mandates, quietly eliminating layers of middle-income jobs while replacing fewer positions than they remove. This is not cyclical trimming, it is structural downsizing. The data reflects it. Job openings have fallen by over 30% from their peak. White-collar hiring rates are now consistent with recessionary conditions, even without a recession label. Small businesses, which employ roughly 46% of U.S. workers, are pulling back sharply as credit costs rise and demand softens. The result is a labor market that appears stable but no longer generates upward income momentum. Technology accelerates this break. AI adoption does not create mass layoffs, it erases replacement hiring. When IBM openly states that automation will replace thousands of back-office roles, those positions do not return in future cycles. Entry-level positions at firms like Accenture and Deloitte shrink. Promotion pipelines thin, income progression stalls, the economy loses future wage growth before current jobs disappear. This matters because the debt system now depends on rising labor income to function. As federal interest costs surge toward $1.5 trillion per year, tax receipts must grow just to offset interest alone. A labor market that stops expanding cannot support that burden. Flat wages combined with elevated living costs reduce discretionary spending, weaken demand, and pressure corporate revenues from the bottom up. Markets assume earnings growth will continue because large firms can cut costs, but cost-cutting is not growth. Apple, Microsoft, and Nvidia may post headline strength, yet the broader economy relies on millions of paychecks outside the top of the index. When hiring freezes spread across finance, consulting, tech, logistics, and retail, revenue softness follows with a delay. This is the illusion. No spike in unemployment, no visible crash, no panic. Just a labor market that quietly stops carrying the system forward. When labor income stops expanding, the system does not break immediately, it bends. And that bending is visible in consumer behavior right now. Spending continues, not because households are strong, but because they are exhausting every remaining financial lever to maintain normalcy. On paper, consumption looks resilient. Retail sales hold up. Travel and services continue. Markets interpret this as proof the economy can absorb higher rates and higher prices. That interpretation is dangerously shallow. What has changed is how spending is financed. Income no longer drives demand. Credit does. Household savings, once inflated by stimulus and lockdown-era spending pauses, have largely evaporated. The personal savings rate has fallen back near multi-decade lows, hovering around levels historically associated with financial stress. At the same time, revolving credit has exploded. Credit card balances have pushed past $1.3 trillion, with average interest rates exceeding 20%. That is not confidence. That is substitution, replacing missing wage growth with expensive debt. Delinquencies confirm the strain. Credit card and auto loan delinquencies are rising across lower and middle-income brackets, even before unemployment spikes. Subprime auto delinquency rates are already near levels last seen during severe downturns. This matters because autos, housing-related spending, and discretionary services are the first areas where consumer stress surfaces. These are not luxury categories. They are core demand drivers. Buy now, pay later platforms amplify the illusion. Short-term installment spending smooths purchases across weeks and months, masking affordability breakdowns in real time. Consumers appear active while balance sheets deteriorate underneath. This keeps revenue flowing temporarily, but it accelerates future demand destruction. Every dollar pulled forward through credit is a dollar removed from future consumption. This behavior is not irrational, it is adaptive. When wages stall and prices remain elevated, households do what systems encourage them to do: borrow. But the macro consequence is unavoidable. Consumption funded by debt is finite. It ends not gradually but abruptly when credit limits are reached or lending standards tighten. This is where the connection to the labor market becomes fatal. Without wage growth, households cannot deleverage. Without deleveraging, they cannot absorb shocks. And without absorption capacity, even small disruptions cascade. A modest increase in unemployment, a pullback in lending, or a rise in servicing costs forces rapid spending cuts. The elasticity disappears. Markets ignore this because aggregate spending data lags reality. By the time consumption weakens visibly, balance sheets are already impaired. Corporate earnings then miss expectations not because demand vanished overnight, but because it was artificially sustained for too long. There is also a distribution problem markets refuse to price. Roughly 70% of US GDP is driven by consumer spending, but that spending is increasingly concentrated among higher-income households. Lower and middle-income consumers are already constrained. Once higher earners slow, and whether due to market volatility, job insecurity, or asset drawdowns, aggregate demand drops sharply. There is no secondary engine waiting to replace it. This dynamic feeds directly back into the debt system. Slowing consumption reduces tax receipts at the same moment federal interest costs surge. That widens deficits precisely when refinancing pressure peaks. Fiscal space vanishes. Policy options narrow. the margin for error collapses. The most dangerous aspect is psychological. As long as consumers keep spending, policymakers delay hard decisions. As long as markets see spending, they dismiss warnings. The system survives by pretending the behavior is sustainable. It isn't. Spending held up by debt is not growth. It is time borrowed from the future at double-digit interest rates. When consumption is sustained by debt instead of income, the system hands the problem to the central bank. That is where every pressure discussed so far converges. Rising interest costs, weakening labor income, and debt-driven spending all meet inside one institution that no longer has a clean move left. The Federal Reserve is trapped by math, not ideology. Inflation is still above target, debt servicing costs are exploding, and growth is slowing underneath the surface. Cutting rates too early risks reigniting price pressure and collapsing confidence in the bond market. Holding rates too high guarantees rising defaults, tighter credit, and economic contraction. Every option solves one problem by accelerating another. Start with rates. Policy rates moved from near zero to above 5% in the fastest tightening cycle in decades. That tightening is still working its way through the economy. Monetary policy operates with long and uneven lags. The full impact hits after labor markets slow and after consumers lean on credit. Exactly where the economy is now. Cutting rates here does not undo that damage. It simply changes who absorbs it. If the Fed cuts aggressively, inflation risk returns immediately. With federal deficits running above $1.5 to $2 trillion per year and Treasury issuance remaining massive, lower rates increase demand without increasing supply. Bond investors react first. Yields rise instead of fall, the dollar weakens, import prices move higher, inflation expectations re-anchor upward. At that point, the Fed loses credibility, and once credibility is gone, rate cuts stop working as stimulus. If the Fed holds rates steady, the opposite failure unfolds. Higher for longer policy tightens financial conditions into a slowing economy. Credit availability contracts, banks reduce lending, refinancing becomes punitive. Defaults rise across autos, commercial real estate, and leveraged corporate credit. Earnings weaken. Unemployment follows with a delay. Markets eventually price recession, but only after balance sheets crack. This is the no-win structure. The Fed cannot simultaneously protect growth, control inflation, and stabilize government financing. One of those three must be sacrificed. In previous cycles, debt levels were low enough to absorb the trade-off. Today, with nearly $38 trillion in federal debt and interest costs, approaching $1.5 trillion annually, there is no buffer left. Quantitative easing is not an escape. Restarting asset purchases would stabilize markets temporarily, but it directly conflicts with inflation control and currency stability. Expanding the Fed's balance sheet while the Treasury floods the market with new issuance blurs the line between monetary policy and fiscal financing. That perception matters. Once investors believe deficits are being monetized, long-term yields rise regardless of short-term policy rates. This is why bond markets, not equity markets, hold the real power now. Equities can float on optimism, bonds cannot. Every Treasury auction is a referendum on confidence. Weak demand forces higher yields. Higher yields tighten conditions. Tighter conditions weaken growth. The loop feeds itself. The Fed understands this, which is why policy becomes hesitant and reactive rather than decisive. Rate cuts are delayed. Guidance becomes vague. Messaging shifts from certainty to data dependence. That hesitation is not prudence. It is constraint. The central bank is waiting for something to break softly enough to justify intervention without triggering a larger backlash. But systems rarely break softly at this stage. The consumer slowdown reduces tax receipts. The labor slowdown limits wage-driven growth. The debt rollover forces constant refinancing. Together, they compress the window for error. Monetary policy loses precision. Each adjustment produces unintended consequences larger than the last. Markets still believe the Fed can step in at the right moment. That belief is the final support holding valuations together. Once it becomes clear that intervention either fuels inflation or accelerates contraction, confidence erodes rapidly. When central banks lose flexibility, markets fall back on one assumption: that valuations are justified by fundamentals. That assumption is now stretched to its limit. Current market pricing does not reflect resilience. It reflects perfection, and perfection is the most fragile condition of all. Equity valuations today are built on a narrow set of requirements that must all hold at the same time. Earnings must keep growing, interest rates must fall without reigniting inflation, liquidity must remain abundant, credit must stay open, and confidence in policy must remain intact. Remove any one of these and the structure destabilizes. Remove several at once, and repricing becomes violent. Start with concentration. A historically small group of companies now carries a historically large share of total market value. The top few names account for a disproportionate percentage of index gains, index earnings, and passive inflows. This creates an illusion of broad market health while masking weakness underneath. When flows reverse, concentration accelerates the downside. There are fewer buyers, fewer stabilizers, and far more forced sellers. Valuations assume that earnings growth continues uninterrupted, yet earnings growth increasingly depends on cost control, financial engineering, and multiple expansion rather than expanding real demand. Margins sit near cycle highs at the same time labor income slows and consumers rely on debt. That is not a stable foundation. It is a late cycle distortion. Rates are the silent amplifier. Equity prices remain elevated because markets expect lower rates to justify higher multiples. But lower rates are not guaranteed to translate into lower yields if bond markets question inflation control or fiscal discipline. If long-term yields remain elevated while short-term rates fall, valuation math breaks. Discount rates rise even as policy loosens. That scenario is not priced. Liquidity assumptions are equally dangerous. Markets behave as if liquidity is infinite and responsive. It is not. Liquidity exists only when participants trust exit conditions. Once volatility rises, liquidity disappears first in derivatives, then in credit, then in equities. Passive investing accelerates this process. ETFs provide instant exposure on the way up and instant exits on the way down, compressing timeframes and magnifying moves. Credit markets are the hinge. Equity valuations implicitly assume credit stability, that refinancing remains available, defaults remain contained, and spreads stay narrow. That assumption conflicts directly with higher for longer rates, massive refinancing needs, and weakening income growth. When credit spreads widen, equity multiples contract rapidly, regardless of earnings. This is why comparisons to past bubbles miss the point. This is not a speculative mania fueled by retail excess. It is a structurally leveraged system dependent on uninterrupted confidence. Pension funds, insurers, banks, and governments are all positioned for stability. There is no shock absorber left. Volatility suppression itself becomes a risk. Extended periods of low volatility encourage leverage, option selling, and risk parity strategies that assume smooth markets. When volatility returns, these strategies unwind mechanically. Selling is not discretionary, it is automatic. Feedback loops replace price discovery. The final flaw is psychological. Markets believe intervention will arrive before damage becomes systemic. But as outlined earlier, intervention now carries visible costs. Each rescue increases inflation risk, weakens currency confidence, or worsens fiscal stress. That changes investor behavior. When participants stop believing in painless rescues, they stop paying premium valuations. Perfect conditions are not sustainable because they require no mistakes, no shocks, and no policy trade-offs. The current system faces all three simultaneously. Valuations do not reflect uncertainty, they deny it. When valuations depend on perfect conditions, timing becomes everything. Markets do not collapse when problems exist. They collapse when time runs out. That is why this window is narrow and why it cannot stretch indefinitely without consequence. The next 18 months are not dangerous because something new appears. They are dangerous because everything already discussed converges on a fixed schedule. Debt maturities do not wait for confidence. Refinancing does not pause for optimism. Policy credibility does not regenerate on demand. The system is being pushed toward a calendar, not a forecast. Start with debt mechanics. The largest wave of Treasury refinancing accelerates through 2026 and into 2027. This is not discretionary spending that can be delayed. These are obligations that must be rolled at prevailing rates. As issuance surges, markets must absorb it continuously. Any disruption, weaker auctions, rising term premiums, foreign demand retreat, immediately raises borrowing costs. That pressure compounds quickly because higher yields increase future issuance costs. Time works against the system, not with it. At the same time, economic momentum weakens beneath the surface. Labor income growth slows first. Consumption follows with a lag. Earnings react last. Markets are currently positioned at the far end of that chain, assuming growth persists long enough for policy to rescue conditions. But rescues require political, monetary, and market alignment. And alignment deteriorates as stress increases. This is why the window does not open gradually, it tightens. Each quarter that passes without renewed income growth reduces the margin for error. Each rate cut that fails to ease long-term yields shortens the runway. Each month of elevated deficits increases sensitivity to bond market reactions. The system becomes less tolerant of surprises. Why not sooner? Because liquidity is still masking damage. Credit remains available, though more expensive. Consumers are still spending, though increasingly, on borrowed money. Markets still believe intervention will arrive cleanly. These supports delay repricing, but they do not eliminate it. They compress it. Why not later? Because delay compounds fragility. By late 2027, refinancing pressure peaks, fiscal math worsens, and policy credibility is thinner. The longer valuations remain elevated without real growth, the more violent the adjustment becomes. Stability borrowed from the future demands repayment with interest. There is also a sequencing problem markets underestimate. The system does not fail everywhere at once. It fails in order. Bond stress appears before equity stress. Credit spreads widen before defaults spike. Hiring freezes precede layoffs. Spending slows before revenues fall. Each step looks manageable in isolation. Together, they form a cascade. Once one link breaks visibly, behavior changes. Risk tolerance collapses. Liquidity retreats. Defensive positioning accelerates. Markets move faster than policymakers can respond because modern markets are automated, leveraged, and interconnected. There is no pause button. The final illusion is that time itself heals systems. In reality, time without resolution increases pressure. When debt grows faster than income, when consumption depends on credit, when policy choices all carry visible costs, stability becomes temporary by definition. This is why the window is measured in months, not years. Not because of fear, but because of structure. The economy can absorb stress, markets can absorb volatility. What they cannot absorb indefinitely is misalignment. Between debt and income, between policy and reality, between valuation and fundamentals. Nothing here requires a black swan. Nothing requires panic. Only the calendar needs to keep moving, and when it does, the crash won't announce itself as a surprise. It will arrive as the moment the system finally runs out of time.